2024 Market Update. My name is Rachael Crane, Senior Portfolio Manager at City National Rockdale. Today, I'm joined by City National Rockdale Managing Director, Co-Director of Fixed Income, Charles Luke, Managing Director, Senior Economist, Senior Portfolio Manager, Paul Single, and Managing Director, Co-Director of Fixed Income, Mike Taila. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, our presenters will share their perspective on what's in store for fixed income markets and the role fixed income can play in helping achieve client goals. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar. A few logistics before we get started. We welcome your questions, so please type them in to your console's Q&A window anytime during the session. And if you would like to download a copy of the presentation slides, you can do so in the resources window to the right on your console. I'll now turn the call over to Paul Single of City National Rockdale.
Rachael, thank you so much. I really appreciate that. And welcome, all of you. Happy Leap Day. I guess it's the day that salary people work for free. But we've got an awful lot of great information today to talk about in regards to the economy, and more importantly, what's happening in the fixed income world. So that's why we have both Mike and Charles joining us today. In terms of our outlook for the economy and that of the financial markets, in terms of the economy, we have a whole list here on the left-hand side. But I think the important thing is the fact that we have changed our outlook in terms of the possibility of a soft landing and have increased that to 60%. Now, the soft landing is not a foregone conclusion. There's a lot of things that can happen between now and over the next several months. In terms of the economy, I mean, for example, in January, we've seen some very robust data, like in the labor report, which means that we might see an acceleration of the economy. But on the other side of the coin, there's the risk that the higher interest rates might start to bite, and that'll slow down consumption quite quickly. That all said, the probabilities of dramatic changes from the trend that we've been seeing over the last 6 to 12 months or so, we don't think it's going to change a whole lot. And as a result, the trajectory of gradual slowing in the pace of economic growth, the gradual slowing of inflation, will allow the Federal Reserve Bank to start lowering interest rates in the second half of the year. Now, in terms of the financial markets, this changes the scenario quite a bit in terms of our excitement over the equity markets, especially certain categories within that market. And as a teaser for next month, that's what the focus will be on that webinar in terms of having our equity specialists talk. In terms of our outlook, we've only made one significant change to 2024, and that's in regards to GDP, in which case we've increased our view by about 25 basis points, a little bit stronger economy than what we thought just last month. In terms of some of the speedometers, you can see here the top group deals with the fixed income market, all solidly within the yellow spectrum. And yellow doesn't mean moving to red. Yellow just means somewhere between red and green. But the general trend is that it's starting to move up towards the green category on a number of these sectors. But the important parts in terms of the focus, in terms of changes of what we're seeing, we're still looking at the bottom row here. In terms of inflation, it's still looking much better. And the probability of the Fed being able to be confident that the inflation rate gets down to 2% and can stay there is growing more and more each month. In terms of the credit demand and availability, that has moved up. And in terms of the housing sector, that has also moved up a little bit. And that's what we're seeing in some of the banking data that's coming to us. But the housing data, what we've seen over the last few months when mortgage rates have fallen a little bit, was some strong demand in buying. That's just showing that there's an awful lot of pent-up demand for housing, and that's why we're seeing home prices continue to move up. But in terms of the overall economy, this chart here, the columns represent the quarterly change in GDP. Their dark blue is history. This is the real data. The light blue is Wall Street's expectations. This is the survey that's done by Bloomberg. And you can see the dashed line there. That's the trend rate that we've seen over the last 20 years or so. The important issue here is that the expectation is that there will be a slowdown in the pace of economic growth. Nothing moving into the negative territory, just a slowdown. And the slowdown is mainly a result of the fact that consumer spending should moderate a little bit going forward. That's mainly a result of the fact that many people have spent down their excess savings, and the fact that financing costs are quite high make it a little bit more difficult for people to afford big ticket items, and we expect to see the slowdown. But it also is a reflection of a slowdown in the investment by businesses. We had a pretty good surge last year, mainly because of an awful lot of stimulus coming from the federal government. But the expectation is over the next few quarters is that we'll see a little bit of a slowdown there. But it will continue to move back up again and get back to trend by the first quarter of next year, mainly because the Federal Reserve Bank will be lowering interest rates, and that will help increase the demand for credit, which will increase spending a little bit more. So that's all that's seen at this point. In terms of inflation, our view is over here on the left-hand side for both CPI and core PCE. We see that moving down to around the 2.7 to 2.8 to 2.9% range by year end. This will give the Fed a great deal of confidence in terms of believing that inflation can move down to 2%. If you notice the forecast, we're not expecting any jump ups in inflation, which is a bit of a concern for some Fed policymakers right now. That's why they want to wait a few more months before they decide to cut interest rates. In terms of the driving force of what's inflation, you can see it over on the right-hand side where we're breaking it down into the major categories. The gray categories are different types of services. The blue categories are types of goods. Goods inflation, which was the major cause of high inflation a few years back, has pretty much retreated to what we had before the pandemic, close to zero. All the inflation that's being driven right now is coming from the service sector, which is two places. One, housing costs, and two, services without housing, what they call supercore. And this relates mainly to things that are purchased that have a great deal of labor associated with it. Think medical care, getting your car fixed, going to the dry cleaners, that sort of thing. Both of those remain quite elevated, and both of those are quite sticky. And this is a concern for the Fed, but they're watching it and trying to understand these sectors a little bit more closely. But the general belief is that these service costs will continue to move down because we've seen wages move down over the past several quarters. In terms of the unemployment rate, this is where the Fed is really hitting it out of the park. They've been able to bring down inflationary pressure significantly, as we saw on the previous page. But the more important issue is the fact that the unemployment rate has really not budged an awful lot. This chart here, the vertical column that you see, that's when the Fed started to raise interest rates. The dark blue line is the unemployment rate. The green is Wall Street's expectations going forward. The little red area is what the Fed is expecting. But really, it boils down to the fact that the unemployment rate, which is currently at 3.7%, is only expected to move up a little bit, maybe back to the level it was before the recession started, which was 4.2%. The Fed thinks it's going to be at 4.1%. That's not much of a movement at all. The labor market has been unbelievably strong. The unemployment rate's been below 4% for 24 consecutive months. We haven't seen that since the 1960s. So it shows you how strong this economy is at this stage. So without much of a change, it probably won't have that big of an impact on the economy in terms of causing a recession, and that's the important thing. That's why the soft landing is viewed so positively by so many people, because the unemployment rate and the demand for workers continues to remain very, very strong. I mean, we've seen the unemployment rate move up from a low of 3.4%. At one point, it was a high of 3.8. But the thing is the non-farm payroll number never went negative. It always stayed positive. But there are developments that are happening in the labor market that's changing it to some extent, showing that we expect to see some more moderation. First of all, the chart on the left, this breaks down the different types of jobs, those that are high paying versus those that are low paying. And the definition is relatively simple. If you're above the average pay, that's a high paying job. If you're below it, that's a low paying job. But we're seeing the same sort of scenario this time around like we saw in the last business cycle. Initially, it's the high paying jobs that get filled first. As those people are employed and start spending money because they're confident about the future, they buy an awful lot of services, and that starts employing lower paying jobs. And we saw that, like I said, in the past business cycle, and we're seeing it again in this cycle. Now, this is an interesting caveat to the story. We continue to see wage growth percentage change continue to increase. And most of that's happening at the lower paying jobs. You can see that here on the right-hand side. These are the 13 categories that the Bureau of Labor Statistics looks at. Then they're in order from lower paying jobs on the left-hand side to higher paying jobs. And it's measuring the percentage change. So you can see the big increases that tend to be happening at the lower end. You can see it with the trend line. But what this means is, although the lower end is getting higher percentage increases, and that's helping to drive up that percentage number for wage changes, a high percentage on a low paying job does not provide as much dollars to be spent in the economy as the smaller increases at the higher end of the spectrum. And as a result, that means less money is being spent. And as a result, that means less consumption going forward. In terms of bank lending, this is a concern, but articles that we're reading, banks are looking at changing things going forward in terms of increasing the amount of credit available. The chart on the left-hand side that you see, the solid line is the total amount of money that has been lent out. The shaded area is the percent change year over year. And you can see the current rate is at 2.4% increase, well below the long-term average of 6.8%. And when you're talking about $12 trillion, that's an awful lot of money. And that's, again, part of the reason for the expected slowdown over the next few months in terms of consumption versus what we've seen over the past year or two. On the right-hand side, it looks like a bit of a mess. It breaks down the major categories of lending that's going on. But the important story here is that it's all sectors of lending has slowed down significantly. It's just not lending to commercial real estate, or more specifically, office real estate. And one of the reasons is the fact that rates are very, very high. I mean, we've seen interest rates move up, but rates on loans are a whole lot higher. These charts here, the dark blue is the lending rate for whatever we're looking at in terms of, on the far left, small business borrowing, the middle auto loans, and on the right, mortgages. The light blue line is the corresponding treasury of about the same maturity, and the shaded area is the variance between the two. But you can see the variance is well above what the long-term average is for that variance. I mean, it moves around, but it's extremely wide. It's between 1.5 to 2 percentage points higher. So accessing credit is quite expensive at this stage. And again, that's part of the Fed's strategy. That's part of why we believe that the pace of economic growth will slow, because the cost of credit is high, and that will slow down borrowing. And then finally, the Federal Reserve Bank and the federal funds rate. The dark blue line here is the history, and you can see various expectations. The green is probably the most extreme example back in December, where the market was thinking up to 7 interest rate cuts this year. Much different than what we had been forecasting back in December. At that point, we were saying the Fed probably will not cut interest rates until the second half of this year, and it'll probably be 2 to 3 interest rate cuts. We're still holding true to that, but as you can see here by the chart, the market's expectation is starting to move that way. The Fed says 3 cuts of 25 basis points each. The Fed funds market now says 3.2. That's as of just about 10 minutes ago, cuts this year. So the expectations have moved much closer to what we've been saying for several months. So with that backdrop, what I'd like to do is turn this conversation over to Mike.
Great. Thank you, Paul. And hello, everyone. So today I'll be providing an update on the municipal bond market, and I'll cover the yield environment, in both the investment grade and high yield markets. We'll talk a little bit about the credit environment, and then we'll talk about the supply and demand dynamics that we're experiencing this year. So looking first at the investment grade segment of the market, and here we use the Bloomberg Municipal Bond Index. And this index, it's a lot like the S&P is for equities. This is really the reference point we use when discussing the muni market. And the index is comprised of investment grade bonds. It includes issuers across all states, and it has maturities between 1 and 30 years. And so the chart on this page, it graphs the yield over the last several years. And it's notable that the index, it hit an all-time low yield of 87 basis points just several months before the Fed started raising rates. It hit what could be a cycle high of 4.49% in October of last year. And then after a sharp drop, we've settled in at around 343 today. So despite the sharp drop that we experienced at the end of last year, if we put this in context, the yield remains very compelling, not only in a historical context where you have to go back to the financial crisis to see yields this high, but more importantly, when adjusted for taxes. And so when we adjust that 343 municipal yield to account for a 37% federal tax rate and a 3.8% healthcare tax on passive income, this equates to a 579 taxable equivalent yield. And for clients that might reside in states with high tax brackets, the taxable equivalent yield can push north of 7%, making this a very compelling case for the asset class. Now, if we turn our focus to the high yield market, and here we use the Bloomberg Municipal High Yield Index as a reference point. And this index is comprised of non-investment grade sectors of the market. And again, we're looking across all states and with maturities between 1 and 30 years. Now, the chart on the left, it shows the spread between the yield on the investment grade index that we just discussed and the high yield sector of the market. And what we see is that the high yield market, it's currently offering about 220 basis points of extra yield over the investment grade index. And at 220 basis points, spreads are near the 5-year average, and actually very close to the longer term averages as well. And this is well below the stress that we saw during the pandemic, but it's also above the recent tights that we saw as we were coming out of the pandemic and experienced during the recovery. Now, if we look at the chart on the right, this shows the absolute tax-exempt yield of the index, and we're currently at 5.62%. And as we look at this market, and even though spreads are near long-term averages, it might suggest a little bit of fair value here. A 562 yield, that translates to a 9.5% taxable equivalent yield. And when you combine this yield with the backdrop of a stable credit environment, we really have the ability to obtain attractive yields with tax-free yields within this space. Now, if we shift gears and turn to the credit environment, at the state and local level, we continue to find budgets well-positioned and credit quality stable. So the chart on the left, it shows the historical tax collection trends. And what we see is that collections have benefited from several years of extraordinary growth, but revenue trends are now starting to normalize. And as we make our way through 2024, we expect to see a mixed picture across the states. So we're going to see some states beating budget projections, and then we're going to see the usual suspects, with these notable headline-grabbing shortfalls. But across the landscape, states have amassed record rainy day funds, and reserves are plentiful to cushion any kinds of shortfalls. And so there's quite a bit of flexibility and maneuverability within state budgets to manage through these problems. And as a result, we definitely expect minimal, if any, credit rating actions at the state level in 2024. And at the state level, we expect credit quality to remain very high at AA+. Now, the chart on the right, it looks at revenue sectors within the market. And here we graph days cash on hand. And this is a very important indicator of financial health within the market. And as we look across these 5 sectors of the market, the story is very similar. As a result of strong economic growth, this recovery and utilization for sectors like toll roads and airports, and then you combine this with good financial management, we see that many parts of the market have recovered and are now exceeding pre-pandemic levels. So there are areas of the market that have also been slower to recover as well. So for example, higher education, we're seeing areas of that market that are struggling with enrollments and cost pressures, and we've been a little bit cautious there. But overall, we've seen solid progress, and our credit analysis continues to be an important part of selection and management, across our portfolios. And then if we dig a little bit deeper into credit, this slide shows the historical incidence of first-time payment defaults for the entire bond market, the entire municipal bond market. It includes both investment grade and high yield segments of the market. And what we see is that the stress remains fairly low when you compare this to other asset classes. Defaults are very rare within the investment grade segment of the market. And when they do occur, they're typically within the non-rated segments of the market. And even then, they tend to be concentrated, amongst a few sectors. So overall, the market default rate is quite low, and especially when you put this in the context of a very large and diversified market with over 50,000 issuers. So the chart on this page, it shows the default activity, that it peaked around the financial crisis. We then experienced, multi-year lows prior to the pandemic. And then we did see a little bit of an uptick in first-time payment defaults in 2020, but they have definitely moderated over the last few years. But we're starting to see some stress within a few sectors. And so, for example, senior living, we've seen occupancy and cost pressures, and it's been a little bit of a drag on performance. And so this is likely to contribute to a little bit of an uptick this year. But overall, we expect levels to remain small relative to the overall market. And then, in addition to, this resilient credit environment that we're in, when we look at the municipal market, supply and demand plays a very important part of the market. And the chart on the left, it tracks fund flows. And the way to think about this is dollars coming into and moving out of the market. And it's primarily within mutual funds and ETFs. And so in 2022, as the yield curve, shifted rapidly higher, the market experienced these record-breaking outflows. Now, last year, even though we ended the year negative, we did see some periods of very, very strong demand within the market. And then more recently, fund flows have turned positive, and we're seeing assets flowing into the longer part of the curve and into the high yield market as well. And this is simply because rates are very attractive right now, and people are buying into the market. On the right, we look at the supply picture. And this year, we're looking for supply to be somewhere over $400 billion. Trailing somewhat below long-term averages here. But what's notable, I think, about the supply picture is that when we factor in demand, demand created from maturing and called bonds, it consistently has been falling short of what's really required by the market. And so when we have these periods where we see demand for the asset class and it really starts to pick up, and then supply falling short of what's really needed, this tends to provide quite a bit of support for the asset class. And then finally, this last slide, it really illustrates the opportunity that we're seeing in the market today. So that on the chart on the left, we show the Bloomberg Intershort Index. And this is a subset of the broad municipal index that we discussed earlier. It's comprised of bonds with 1 to 10 year maturities, and it has an average duration of around 3.5. And when we look at this index, because we typically see a large number of investors gravitate towards this part of the curve. And what this shows is that a basket of bonds with these characteristics yields around 3% today. And remember that 3% municipal yield is equal to a little over 5% on a taxable equivalent basis. And then if we look back over the last 10 and 20 years, the dark blue lines show that the yields averaged 1.71 and 2.14%. But what's more important is the light blue bars. And these show annualized returns over these same periods of about 1.77 and 2.72%. Now, what this tells us is that long-term returns are heavily determined by starting yield. And with starting yields about 100 basis points over long-term averages, we see the potential for much better looking forward returns. And then on the right-hand chart, it's a similar story when we look at the municipal high yield index. Here we see current market yields of 564. And again, that translates to about a 9.5% taxable equivalent yield. And in this case, market yields are slightly above the 10-year average and just slightly below the 20-year average. And over these time periods, total returns have been 4.5 to 5%. But again, with attractive high starting yields, a stable credit environment, we really think that that's going to be a determining factor that's going to drive returns over the long term. And with that, I will turn it over to Charles to talk about taxable fixed income.
Great, thanks, Mike. So I wanted to start and just frame the interest rate environment from a treasury curve perspective. And we all know that the 10-year dropped below about 3.9% in December of last year after peaking in October at about a 5% level. But I'd like to stress that it's gone as high as 4.35% so far in 2024. And you can see that in the left-hand side. What we can also see is on the very far left-hand side of that left graph is that cash rates remain very high. And the 2-year treasury, which is a very good proxy for Fed rate cuts, has actually moved above 4.7%. And so as Paul mentioned and Mike mentioned, that movement is very consistent with our Fed target rate forecast for 2024 of about 2 to 3 cuts. And what I also like to mention is the cost to buy treasuries in the market has also been at an all-time high. So just that spread between buys and sells. And what that signals to us is an increased level of volatility. But just here recently, it's fallen back to a normal trend, which I think supports our 4 to 4.5% target for the 10-year treasury. And my main point in starting here is that volatility has created an opportunity for investors. And I want to stress that even though rates were as high as 5% last year, investors have not missed the boat on investing in fixed income. And so the bottom line is we look at the past 15 years in a zero interest rate environment, investors were earning next to nothing in their bond portfolios. And so the opportunity to extend maturity today and take advantage of well-priced areas of the market is definitely a welcome development for investor portfolios, especially those focused on generating income. And now let's shift into some mechanics of the market and really talk about just what's happening in the markets that are most exposed to the economic cycle. So this is going to be high yield bonds and loans. And so what I've heard, and I'm sure you've heard it as well, is a lot of commentary that's focused on the inability of borrowers, of issuers to refinance. But that's really a myth. So if you take a look at the chart to the left, that shows refinancing activity so far in 2023 for that full year. It was about $334 billion between loans and bonds. And that's comparable to 2019 to 2016, going back to 2012. So that was a pretty decent issuance year. And if we think about what's happened year to date, it's been about $103 billion in refinancing activity. So that's one element. And then if we look at the demand in the market at these level of interest rates, it's higher than it has been, again, for 15 years. But on the right-hand side, you can see that supply in fixed income has been shrinking pretty dramatically, down around $150 billion last year on that right-hand side. So you have this element in the market, this dual positive of issuers being able to refinance their bond positions, and they're doing it when supply is lower and demand is high. So when we're thinking about markets to invest in and how we make tactical decisions, this is what you want. This is a setup that makes sense for investors, and what we call this are positive technicals. And so if we take this one step further, certainly refinancing activity is making up a lot of the new issuance. But the numbers for issuance on a gross basis, so for just normal issuance plus refinancing, are very positive. So if you take a look at this chart, in the dark blue, what you're seeing is the increase in 2024 so far year to date versus the 4-year average of issuance. So you can see that in investment grade taxable bonds, it's up nearly 50%. In high yield, a little lighter, up 4%, but still moving at a very rapid pace relative to the 4-year average. And then in leveraged loans is really where you see the big movement higher at 210%. And then in US CLOs, this is structured credit or collateralized loan obligations, which is built on leveraged loans, is up about 54%. So very nice to see the activity in that market increasing. And then the light blue shows what's happening in 2024 versus the 2023 percentage year-to-date change. Again, you can see high numbers, 34% in investment grade, 55% in US high yield, which is really nice to see in that market, and 305% in leveraged loans, 127% in US CLOs. And what I really want to focus on here is looking at leveraged loans, because this is the area of the market that's going to be most exposed to higher interest rates as short-term rates move higher. So these borrowers, despite paying very high rates of interest, have been able to refinance and still have strong profit margins in their businesses. So that's a very good dynamic to see. So in addition to what we talked about on the previous slide with the positive technicals, the market has also been able to digest a lot of this new issuance in stride. So that means there's been very little impact to pricing from the increased issuance that we've seen. And that's just another nod to the high demand that's in the market. And we'll talk about how risk is priced in just a bit. But when we look at all these dynamics in the market and combine them, it is a general reason why risk pricing at these types of levels, these tight levels, may continue. So if issuers can refinance, demand is high, and supply is clearing the market, risk pricing can remain low for extended periods of time. And keep in mind, with yields this high, so between 7 and 8% in high yield, the opportunity cost of not investing in these markets is giving up a pretty substantial amount of income. And so for that reason, we want to stay overweight the high yield sector in our portfolios. And if we start to move into the default picture, after we've taken a look at treasury yields and corporate market dynamics, one of the things that I've highlighted on these calls over time is the impact of what we call the maturity wall. So that's just looking at how many bonds mature over time. And I've also mentioned that at some point, the maturities do have to start to build up. But as we've discussed, borrowers are starting to take advantage of the market to position their balance sheets with better near-term maturity structures. So while this does remain a primary risk in our minds to the market, the timing of that impact has been pushed out. And if we look at the chart in 2024, only 40 billion of maturities are hitting the high yield bond and loan markets, which means that even in the absence of the ability to refinance, borrowers will face very little pressure from maturities this year. But it definitely can't last forever. So if you look at 2025, the amount that's coming due in that year is nearly a 5 times jump from what we're going to see this year. So again, it does remain one of the primary risks in the market. And if we look at defaults specifically, there's been a lot of talk about them rising, and they certainly have. So we've seen about a 2.5% to 3% jump back to the historical averages. But the interesting part about this is that the spike in defaults came in April, May, June, and October of 2023. So the actual volume of defaults from about October of last year to January has dropped from 9 billion to 3 billion. And keep in mind that the way default rates are measured are on a trailing 12-month period. So it's just looking back at the past 12 months. So we're really curious to see, once we get through March of 2024, if the default numbers actually show a potential near-term peak and a trend that starts to move a little bit downward. But I also want to focus on some of the areas and the names that are defaulting. So if we look at all of the borrowers that defaulted over the past 12 months, 23 of the 88 borrowers were actually repeat offenders. So that means they've actually defaulted in the near term prior to 2023. So that's a record high in the market of 26%. And it's safe to say we just don't own names like that. Notice as well on the right-hand side of the chart that distressed bonds, so these are bonds that are trading below 70 cents in the dollar, are heavily concentrated in a few sectors. That's cable and satellite, healthcare, technology, and telecom. And if we look at this in aggregate, in 2023, 11 issuers, just 11 borrowers, represented 50% of the overall default rate. So again, it speaks to this heavy concentration. And if we parse it even more, we look at the 2 largest defaults, and that was for Envision Healthcare, a double C rated bond, very low quality, defaulted on about 10 billion in debt, and that was a surgery center owner. And then Diamond Sports, a triple C credit, again, very low rated, a sports marketing company, defaulted on 8 billion. Collectively, that represented 23% of the defaults alone, just with those top 2 issuers. So ultimately, the way we look at this is that the rise in defaults is certainly not something we're going to shrug off, but it's definitely concentrated and focused on credits that have been in lower rated tiers and are clearly struggling and were struggling prior to the pandemic. And if we turn it to portfolio positioning and how we invest, over 80% of our high yield SMA strategy is in BB bonds. So that's the highest rated tier of high yield, and they have very low risk of default. So we believe we're very well positioned if a pullback does occur, and we haven't given up that much return by moving higher in quality. So let's move into valuation. And first, I just want to describe, just to remind everybody, what a spread is. And so if we take a high yield bond, let's say it's trading at 7%, relative to a treasury bond with a similar maturity of 5%, the spread is just the difference between those 2 yields. So it's 2%, or what we'd say is 200 basis points. And what you can see from this slide, looking at valuation, is there's a pretty wide dispersion across sectors in terms of risk pricing. So you can see that if we look at communications, it's trading at the cheapest levels, about 5.54% over comparable treasuries, while energy continues to trade very tight at about 2.17% over treasuries. And further, there are about 6 sectors that are trading below the index spread, and you can see that in the yellow line. So it's just further proof of the concentration of the stress in the market. And second, on the previous slide, I just made the comment about returns and the fact that we haven't given up much to the index with a conservative position. And so the chart on the right-hand side shows that. There was a lot of chatter in the market last year about the fact that triple Cs, the lowest quality debt in the sector, had outperformed other areas. But all in, it was just about 3%. So we had a return of nearly 11% by holding 80% double B bonds relative to what we would have had in triple C. And so it's really not worth the credit risk for us to extend out into highly distressed positions, especially at these spread levels. And so we end up with the question of why hold corporate credit at these levels? And I think the real key to this is gross yields. So the last time yields were consistently at or above these levels was prior to 2008. And spread levels persisted there for about 2.5 years. We also saw very tight spread levels from 2016 to 2018 and during the pandemic. And we have to keep in mind that the equation is very different when yields are low. Investors aren't giving up much yield by being uninvested, but with yields at these levels here, the opportunity cost, despite these low spreads, is much higher to wait and not earn that income, and it's certainly very difficult to time. So we continue to recommend that investors buy fixed income to full weights in the allocation and overweight the high yield sector. So on the next 2 slides, I want to spend some time just on the general market overall and the maturity conversation. So should investors extend portfolios, extend maturities or not? And ultimately, we do see a good opportunity for investing in longer maturities now within bonds, but I'd say that it's not for everyone. And so if you look at the unwind of market expectations for Fed cuts and changes in forward rates, which you're seeing on this slide, going out to longer maturities should be measured as investors do it. And the reason is that when we see high volatility, especially in a balanced portfolio, investors should be reserving some funds to be able to buy dislocated markets if and when they occur in the future. And so as I mentioned earlier, no investor has missed the opportunity to extend maturities, but it is heavily dependent on your unique goals and objectives. And Rachel's going to discuss that at the end. And so what I wanted to take a look at here is highlight some of the advantages to the current market. And so I'm sure you keep hearing about how bonds in this environment are more defensive, but it probably ends there. There's not much of an explanation. So I want to unpack that for you a bit. And what we're showing you here is a graph of the outperformance as rates rise between a bond that's yielding 2.4% in a low interest rate environment and a bond that's yielding 4.8% in a high interest rate environment. So if you follow that orange-yellow line with me, in an environment like 2022, when rates rose more than 2%, so 200 basis points, the 4.8% bond would outperform that 2.4% bond by about 4%, which in an intermediate bond portfolio cuts the negative performance nearly in half. So the advantage to fixed income at these higher interest rate levels, why you're hearing that it's defensive and more protective, is because it's superior to be at a higher yield level relative to where we've been for the past 15 years. So bonds just do more. They work harder in a portfolio today. And so I'm just going to end with the overall level of a snapshot of where we are. So if we look at the left-hand side of this graph, we've got investment grade sectors of the market, all the way from 6-month treasury bills to investment grade municipal bonds, tax adjusted at the federal rates. Then we've got investment grade corporate bonds. And on the right-hand side, you can see high yield muni bonds, high yield corporates, leveraged loans, and structured credit. And so the yield levels available to us today in the market, I think is an exciting opportunity. It's a rich opportunity set. We haven't had the ability, we haven't seen the type of divergence in this market over the past 15 to 20 years that we see today. So as investors are constructing portfolios, as you're looking at the balance, fixed income can be a much better tool and help you either increase your forward returns with similar levels of risk that you've experienced over the past 10 years, or allow you to increase returns with the same level of risk. So we think we're in a very good position from a fixed income perspective to take advantage of the markets, the way things are moving, and certainly to earn higher income levels as we move forward. So I'm going to end my section there and pass it to Rachael.
Thank you. It's always wonderful to hear someone talk about how exciting fixed income is. And as a portfolio manager, we're always thinking about how do we build portfolios, bringing all of this information together to build portfolios for you and for your clients. So starting with this slide here, all of you on the call who are familiar with City National Rockdale know that we can build a variety of portfolios, ranging from very aggressive to very conservative, portfolios that are focused on income, portfolios that are focused on total return. And this chart really just lays out that landscape. But we're going to focus today, continuing on with the fixed income discussion, on the left-hand side of this chart, really thinking about how does fixed income contribute to overall portfolios and intellectually personalized portfolios specifically. So many of you know this, but just to highlight a few of the key points here, what does fixed income contribute to a portfolio? Obviously, cash flow. After-tax cash flow is very important. Capital preservation, even inflation mitigation. We'll talk a little bit about that. And as that comes together, what is the impact of making decisions within the fixed income portion or the fixed income and client portfolios to increase the probability of reaching client goals? So we put together this chart, and I'll just talk you through it a little bit. And many of you have seen this. This is our Galaxy output, our system where we analyze portfolios and track goals and do a little forward projections, and we'll get through a couple other slides. But this is an example of clients with specific goals from a cash flow perspective, for retirement spending being a priority. And we put in here on a $5 million portfolio, a goal of having retirement spending of $150,000 per year, of charitable giving, $25,000 per year, of travel, $25,000 per year, education, $60,000 during specific time periods, and an end of life goal to bequest $1 million. And the question is, how do you build a portfolio where we can see the probability of reaching these goals be 100%, as you see here? And one of the key factors is not only getting this cash flow, but keeping as much of this cash flow as possible. So if we take those same set of goals, but think about that investor being in California as an example, and the yields that we can get on California bonds, as Mike mentioned, California being a client in California in the highest tax bracket. So that's 37% in the federal tax rate, a 3.8% Medicare charge, and then 13.3% in California state. So if we start with $5 million and we earn a tax exempt yield of roughly 2.78, which is around what we're seeing today, that after-tax yield actually contributes significantly over a longer time horizon. And that's what you see here as the end result, 7.6 million with the tax-exempt yield relative to the after-tax yield. So not only is it about cash flow, it's about getting the right kind of cash flow. You probably wouldn't be surprised though, but often we see portfolios that have been constructed outside of City National where clients are in high tax brackets and they're using taxable fixed income. At the end of the day, that doesn't actually really support the goals and limits the amount of wealth creation that can result. So that's one of the examples we're looking at. The other thing that we're thinking about is one thing Charles had mentioned about overweighting high yield. So how do you build a portfolio that is going to generate cash flow, good after-tax cash flow, and gives you more than, say, what you can get at the bank, what you can get in a CD? Often questions come up, should I just sell everything and go buy CDs? My local bank is offering 5% CDs. And the answer to that is we project our forecast through the future. A portfolio that just has one type of fixed income is likely going to be less optimized, end up with less wealth, and have a lower probability of success of reaching client goals. So we've outlined 3 examples here, again, using that $5 million portfolio. If you're in cash today and the client has the goals that I went over previously, and we look out over till about 2043, looking about 20 years forward, can this client spend what they want in retirement? Can they do the charitable giving? End of life, have that $1 million bequest? Well, they can in just cash, based on our projections, but the rate of change, the outcome here at a 50% confidence level, looks like by the end of life, they're getting really close to that concern of running out of money. Contrast that to just investment grade bonds. So we like investment grade, obviously, for the capital preservation, for the defensiveness, or good opportunities right now. And you'll see again here, goals are met. We're able to supply that kind of cash flow and the $1 million bequest at the end of life. But an optimized portfolio where you use both investment grade, high yield, or opportunistic income actually leads to the highest probability of reaching the goals, the least amount of risk of running out of money, and the greatest wealth creation. So even when we think about how we manage the fixed income portion of the portfolio, we find that the decisions that we make and the way we optimize for what's happening in the interest rate environment relative to client goals is very key to the long-term success of those financial plans. With that, I'm actually going to turn it back to Charles to summarize a few key points here for our webinar.
Thanks, Rachel. So I won't take too much time here. I know we want to get to questions, but I just wanted to bring everything together for everyone, summarize our top 5 takeaways. And I've gotten a couple of questions in the chat here just about what we actually expect returns to do. So I'll run through that really quickly. So first and foremost, we think there's a tailwind for fixed income because of the inflation glide path. Now, it's going to be choppy. We've seen that here recently with some of the inflation data, PCE today, CPI a few weeks ago, but overall it is positive for the fixed income backdrop. The second thing is that a positive economic outlook, despite what is probably going to be falling growth, does minimize credit risk. So as Mike walked through and I walked through with the tax-exempt and taxable markets, we do see strong fundamentals underlying credit. And we are optimistic about returns. So as I mentioned, it's fun to be able to use the word excitement about fixed income. And we do see plenty of opportunities out there. And we welcome the dispersion just because it's going to give us so many more opportunities to position and be tactical. We think right now, based on what we see in the environment, that the portfolios are appropriately positioned. You know, we have high graded the portfolios. We are looking for a lower growth rate. And really, I'd say just looking to strike when we see dislocations in the market to be able to reposition. And the last thing is active management is going to be so much more helpful in fixed income as we move forward. In a low interest rate environment, the word that I kept hearing over and over again was commoditized. Fixed income markets, rates, they're all the same. It's a commodity. But now, because we have so much more dispersion in different rate levels, whether it's maturities, whether it's ratings, or whether it's markets, active management across those, the ability to be tactical is very important. And to end, when we look across these return expectations in 2024, from taxable investment grade through to opportunistic income, I just want to remind everyone, these numbers, if we go back to early 2022 and late 2021, was essentially 0 to 2% across nearly all of them. So looking at 5 to 6% for high quality bonds, 6 to 8% for taxable high yield, 3 to 4% for tax-exempt investment grade, 4 to 5% for tax-exempt high yield, and 6 to 8% overall for opportunistic income, again, just supports that backdrop for positive performance and very additive performance from fixed income as we move forward. So I'm going to stop there. I'll hand it back to Rachel for Q&A, and I look forward to your questions.
Great. Thank you, Charles. A quick reminder that if you have a question, you can submit it in your Q&A console. It looks like we have had a couple that have come through already. Charles, thank you for taking that first one. I'm actually going to back up a little bit, and this question is for Paul about inflation. So, and this is something I also hear very commonly as a portfolio manager. So the inflation reports indicate that we are seeing inflation has been coming down, but for the average household and consumer, it doesn't really feel that way. So when do we expect to see a change in our day-to-day lives from the perspective of inflation?
Yeah, that's something that behavioral economists struggle with quite a bit. because households and Wall Street are all looking at the same data. It is an apples to apples comparison, but how they view it is very, very different. Wall Street analysts, the Fed, they all look at the percent change in inflation, like on a year-over-year basis. And in that case, as you mentioned, inflationary pressures are moving down. But households are different. They look at the absolute price. They remember when butter cost X and now it's Y. Milk, the same sort of thing. Actually, in today's Wall Street Journal, there was an article about auto insurance and how that, since the pandemic, or since right before the pandemic, auto insurance is twice as high as overall inflation. And that's something that people notice right away. And that's the issue, is that they focus on the cost price. It wasn't presented today, but there's a chart that I use in an awful lot of speeches, and it just shows how income has changed since before the pandemic. And that's the thing that households don't pay attention to, is that side of the equation. People are earning a whole lot more money. Since January, right before the pandemic, income is up like 25, 26%. CPI is, I think it's around 21%, and PCE is up like 16 or 17%. So just on income alone, people are earning more than what inflation is. So financially, they're far better off. Add to that the wealth creation from how much the stock market has rallied and how much their homes have rallied. They're in much, much better shape. But the behavior of people is they just remember what the price was and what it is now, not keeping track of the fact that their income has surpassed the price increases and they can afford it a whole lot easier than beforehand.
Yeah, that's a great perspective. We want both, right? We want higher wages and lower costs. Can we get that somehow?
Yeah, and we won't see the costs go back down. And we saw that with eggs once, the bird flu was behind us. But by and large, prices don't drop back to where they were before. That's deflation. That's not what the Fed wants. They just want to see prices not increasing as much and wages increasing at a faster pace.
Right. Okay, well, thank you, Paul. We've had a couple more come in. So, Mike, why don't I pass this one to you about commercial real estate? So could problems in the commercial real estate market impact the municipal credit quality? Do you have any concerns on that?
Yeah, no, that's a really a great question, Rachel, and we've actually been getting that, quite frequently recently. And, focus on the commercial real estate market is definitely something our credit team has been, monitoring quite closely, especially for any impact that, we might see at the local or city credit level. The largest impact, would likely be seen in cities like New York or San Francisco or Chicago or Los Angeles, where, falling property valuations could lead to weaker revenue streams. But it's worth noting that, revenues at this level tend to be, quite diversified. So commercial property taxes, are only one part of the equation, and it's actually a very small part of that. So, when we think about residential real estate, that tends to be the largest, contributor to local taxes, and it's a very stable source of taxes. And then, you have to throw in other sources of revenue along the way, sales tax, corporate taxes, or, there's a handful of others that local governments rely on. So, we actually expect this to play out over time. This is going to give, management teams plenty of time to incorporate any expected shortfalls into their budgets, and with balance sheets starting from these very strong positions, after years of solid growth, we think the problem is manageable, and we don't expect to see a wave of impairment. So, along the way, though, it is going to be, very, very important for us to just maintain consistent credit work to really understand, in depth the challenges that may arise.
Mike, thank you. One more for one that just actually came in for me is a couple kind of personal questions about a financial plan specific to this individual. And let me just suggest, as it relates to, can you get a similar analysis as I had shown in terms of probabilities of success, maybe some decision making, please feel free to reach out to your, oh, looks like I have a buzzer going. Let me just give that a second and I'll finish up here. But feel free to reach out to your portfolio manager or your senior investment consultant, and we'd be happy to put that together for you. One last question for Charles, and then we'll wrap it up. You did talk a lot about refinancing and issuance as keys to assessing the health of the corporate market. But what have higher interest rates meant for underlying fundamentals?
Sure. So, issuance is positive. Bonds are being digested into the market. We're not seeing bonds get hung up out there, not being purchased, staying on essentially balance sheets, right? So that's very positive. But if we think about the underlying fundamentals, so higher interest rates, we're still refinancing, that's great. But what is it doing to revenue? What is it doing to profitability? And one of the areas we really like to drill down into is what's happening in the middle market. So what's happening with small businesses. And we have a view into this because of a lot of the positions that we take in some of our opportunistic income strategies. And when you look at just overall gross revenues, it's still above 10% in double digits. And profitability from a net margin perspective is somewhere between the 7 and 9% range. And if you look at the public markets, even on the broad corporate side, we are expecting, Tom Galvin is projecting in his team, earnings to rebound in the second half of 2024. So to again start moving positive north of about 5%. So even though growth is slowing, the probability that it goes negative is decreasing. And because of prices that are able to be charged, because of the fact that we're able to refinance and mix up that overall sort of debt balance on balance sheets, and then we still have nice gross revenue and nice profitability, the backdrop, we just don't see it to really be impaired for defaults to really ramp up to that 6, 7, 8% type of level that we tend to see in a credit cycle. Now, it's not going to be all Goldilocks forever, but when we look in that medium term over 2024, it's definitely hard to find areas in the corporate market that you just think are going to break. We just don't see a lot of pent-up risk built up in those markets.
Great, thank you. And we will end it there. Thank you all for joining us. A brief survey will pop up shortly in your console. So please share your feedback and suggestions for future topics. A replay will be available within 24 hours, and you'll receive an email letting you know how to access it. Have a great day, everyone. Thank you very much.
Bye-bye.